Charlie, you're a value guy. And so I'm sure that you have been watching this trend very attentively as well. Uh, Value has been struggling over the past decade or so. Do you think that this is going to be a longer term shift in the market that's taking hold right now?
Well, it's important to emphasize that it's a return to the traditional shift, to the traditional relationship. Value has beaten growth consistently for more than 100 years since finance professors started tracking it. The statistic we would like to quote is that value has beaten growth for every rolling 10-year period since 1926, except for the last 10 years. And you're absolutely right. The last 10 years have been brutal for value. But we got to the point where value became so cheap relative to growth that we really did think some kind of reversal was almost undeniable. And we're seeing it. Since the end of the third quarter, since September 30th, the Russell 2000 Value Index is up 24% compared to 8% for the S&P 500. That's 1,600 basis points of outperformance.
And Charlie, when you look at what's happened in the market just this year, it seems like we've had several market cycles within the last 9 months, really. And I would ask how you think about the next decade, because you mentioned the decade we're coming off, that aberration where growth outperformed value, kind of based on the work you guys have done. Are you concerned at all that we've compressed perhaps an expected strong period of value into just a couple of months, given how fast things change in the modern market?
So that's a great question. We still think the valuation disparity is outsized. At the end of the third quarter, the S&P 500 was trading at 23 times forward, and the Russell 2000 value was trading at 13 times forward. That's a 10 multiple point gap, and that's one of the biggest gaps we've ever seen, other than the year 2000. So now, after this massive rally, we're still at 8-point differential. So we still think there's a lot of room for value to outperform. And what's going to happen over the next 10 years is that interest rates eventually will return to more normal levels. And when they do, that helps value, because value's earnings, a value company is making money today. A growth company is making money 10 years from now. So higher interest rates help value relative to growth. And frankly, we think it's dangerous what could happen to growth stocks if we get a return to normal interest rates, because that discount rate is going to bring those future earnings back almost like gravity. And it's going to really, in our opinion, affect growth stocks.
Charlie, aren't those higher interest rates still, though, at least a couple of years down the road? I mean, I know one of the other areas, one of the traditional value areas that you like is financials. You named a couple to us in a note: Goldman Sachs, Northern Trust. And while they're hanging on for those higher interest rates, the lower interest rates, especially for Northern Trust, which doesn't have the trading business to offset, that's not fantastic for their business.
Yeah. So we think interest rates can go higher faster than a lot of people think. I mean, I think the general perception, and I fall into this, is to think that interest rates have been at this incredibly low, below 1%, 10-year forever. Back a mere 2.5 years ago, we had a 3% 10-year. It's in 2018. So if we get even a 3% 10-year again, we think that this effect will kick in. And the other thing I would mention is that inflation could come in a hurry. When you're running $3 trillion deficits, when you have the government talking about forgiving student loans, when you have the kind of infrastructure spending that people are talking about, you can get a lot of inflation in a hurry, particularly when the economy starts to heat up again, when we all go back to work. So I think we could get higher interest rates faster than people think.